In this video, I'll be sharing with you my Insider Buy Superstocks summary and some of Jesse Stine methods. The book Insider Buy Superstocks is by Jesse Stine. So who is Jesse Stine? Not much is known about Jesse Stine, but what we know about Jesse Stine is that he turned $46,000 into $6.8 million. And he managed to generate this 14,972% returns in just 28 months. That's really spectacular trading results. So in today's video, we'll be taking a look at some of Jesse Stine methods and how he trades the stock market. Before we take a look at Jesse Stine's trading methods, I want to talk about this Pareto principle mentioned by Jesse Stine. In the book, Jesse Stine mentions about this Pareto principle, which is to focus 100% on the 20% of variables that actually make a difference in our investing and trading. He points out that successful investing requires us to examine the basics in an organized fashion and disregard the rest. So he wants us to focus all out on the 20% of variables that actually make a difference in our investing and trading and put aside the rest of the information. I think with the current abundance of information available online, this Pareto principle is really important for us as investors and traders in the stock market. Because daily we are bombarded with information about the stock market, be it on news articles, videos, or even on Facebook. We are presented with a lot of information about the stock market. So this Pareto principle teaches us to just focus on the 20% of variables that makes the largest amount of difference for our investing and trading results, and we disregard the rest of the 80% of information that does not make a lot of difference in our investing and trading. This is a quote by Mark Minervini, who is also a very successful investor in the stock market. He mentions that the power of narrow focus is amazing. The key is to be a real pro at something. Know all you can about a style or tactic, then you can build on that foundation. Traders give up too easily and jump around too much when things get difficult. How good do you think Kobe Bryant would be if, while he was developing his skills growing up, every time he had a really tough game, he changed to a different sport or play a different position? Notice what Mark Minervini mentions. He mentions that we should narrow our focus on a particular skill, and that the power of a narrow focus is amazing. So in today's video, I want to share with you the 20% in Jesse Stine's trading book, Insider Buy Superstocks, that can make the most difference in your investing and trading. The first thing that we'll take a look at is what to buy. Jesse Stine mentioned that we should focus on the charts, because charts paint the whole picture before the fundamental story becomes evident. This is because usually the price charts and the technicals of a stock gives us a buy signal even before the fundamentals are known. And only after you see a strong chart pattern, then you should begin to look for the fundamentals of a company or the stock. We'll take a look at the technical criteria first and then the fundamental criteria. It must be in this order, right? So first is the technical criteria, and then second, followed by the fundamental criteria. The first technical criteria is that the stock must be under $15. Jesse Stine mentions that as a matter of arithmetic, the stocks with the largest percentage move begin their moves from lower prices. But with that said, Jesse Stine also points out that he wants to look for stocks with prices above $4. Ideally, the range should be under $15 and above $4, because stocks that are priced lower than $4 tend to be more shoddy. The second technical criteria we want to look out for is for the stock to break out of a strong base. We want to see a stock that has traded sideways in a narrow range for an extended period of time. An extended period of time is anywhere between a few weeks to a few months. And the longer a stock sets up in a base, the larger the ultimate advance. The base that a stock sets up also provides a level of support which prices are unlikely to trade below. This level of support for the stock helps lower the risk and increases the risk to reward ratio. Let's take a look at an example. For this chart, can you see where the base is? The base is over here. After the stock breaks out of the base over here, the stock charges up from around $30 to all the way to $69. That's more than a 100% increase in stock price in just a couple of months. And this huge move to the upside was preceded by a strong base. And the strong base was formed over at this area over here. From around July to November, which is about 5 months, the stock traded sideways in a narrow range. And when the stock finally breaks out of the strong base, the stock charges a hit. That is the second technical criteria that we want to look out for. The third technical criteria is that we want to see a stock being above the 30-week moving average or the 150-day moving average. The 30-week moving average is the same as the 150-day moving average. 30 weeks is equivalent to 150 days. Ideally, Jesse Stine mentions that we want to see a stock to start its move upwards to be close and above the 30-week moving average or the 150-day moving average. The green line represents the 150-day moving average. We ideally want to invest and trade in a stock which is above the 150-day moving average. So from here to all the way here, you can see that the stock price is above the 150-day moving average. And Jesse Stine mentions that we ideally want to enter when the stock is close or just above the 150-day moving average, which is at this point over here. The fourth technical criteria is that we want to see a stock show massive volume, and this is best seen on a weekly time frame. And this ties into the earlier point about a strong base. Super stocks tend to exhibit low volume for extended periods of time during their basing. The basing refers to the base that the stock is forming for a couple of weeks to a couple of months. And when the stock finally breaks above the base, during the advance, we generally want to see high volume on up days and low volume on down days. The fifth technical criteria that we want to see is that we want to see the stock rise in a steep angle. A steep angle as defined by Jesse Stine is around 45 degrees. It can be even steeper if more people jump onto the stock. So anything greater than or equal to 45 degrees. Now we'll take a look at the fundamental buy criteria. For the first fundamental criteria, we want to take a look at earnings. Jesse Stine mentions that we should pay attention to stocks with quarterly revenue and earnings per share that have not deviated significantly from each other over the past few quarters. And ideally, we want to see earnings trending higher over the past few quarters. In addition, we also want to look for earnings per share or EPS in the most recent quarter to jump significantly higher than previous quarters. In the book, Jesse Stine did not define what is significantly higher. In this case, it's based on our individual judgment. The second fundamental criteria is to look for sustainable earnings. So even though we want to see a significant jump in earnings per share, we don't want the earnings to be one-off. So how do we forecast that earnings will be sustainable? These are some questions that we can ask ourselves. For example, has the company recently started selling a new product? Has the company embarked upon a sustainable cost-cutting or profitability initiative? Does the company have any new customers? Has the company recently discontinued an unprofitable division? Or is there a new industry-wide catalyst affecting sales and profitability? If you have some yeses to these questions, it is likely that the company's earnings will be more sustainable. We can also read the quarterly statements or reports or even listen to the conference call for clues. Because especially during these conference calls, the company might give out clues regarding its future revenue and profitability. The third fundamental criteria that Jesse Stine takes a look at is the annualized PE to be less than 10. How Jesse Stine calculates the price to earnings ratio is a bit different from the traditional way of calculating the PE ratio. He calculates the price to earnings ratio by taking the run rate, which is the quarterly EPS multiplied by 4. He will take the earnings per share for the latest quarter and multiply that by 4, and then he take the current price of the stock divided by that earnings per share. And for that, he wants to see the price to earnings ratio to be 10 or less. This is not a very strict criteria for Jesse Stine. He mentions that below 10 is ideal, but he mentions that we can still buy stocks which has P ratio of more than 10 if it fulfills the other criteria. He says that a P ratio of below 10 is ideal because when we are entering a growth stock at a low valuation, it limits our downside risk immensely. So as long as the risk to reward ratio is favorable, even if we were to buy a stock which has a P ratio of more than 10, Jesse Stine still believes that it can be a good investment or trade. The fourth fundamental buy criteria is we want to see sequential improvement. Ideally, we want to see a company whose revenue and earnings are increasing every quarter. We also want to see an increase in year-over-year revenue and earnings comparison. This is also linked to the earlier point about sustainable earnings. We do not want to invest in a company whose revenue and earnings are just a one-off thing. We want to see sequential improvement in the company that we are investing in. The fifth criteria is high operating leverage. Operating leverage is how much a company's net income will increase per dollar of additional revenue. Firms with high operating leverage tend to have low level of variable costs relative to their fixed costs. Ideally, we want to find a company with soaring revenue and extremely low variable costs. This is because companies with high operating leverage tend to be better able to scale their businesses. And the better the ability of a company to scale its business, the more likely the stock price of that company will rise. The sixth fundamental criteria is increasing backlog. Backlog is defined as the amount of future business a company currently has under contract but has not yet completed. By paying attention to the increasing backlog, we can know roughly how much revenue the company will earn in the coming quarters. And that will give us as investors in the company a better idea on how to forecast the future of the company. An increasing backlog figure gives the investor further confidence that the firm's financial performance will continue to surge in the coming quarters. So where can we find the backlog of companies? Some companies will include a backlog figure in their earnings release. So that's another additional reason to pay attention to the earnings release of the companies that we are investing in. The seventh fundamental criteria is open market insider buying. Jesse Stine mentions that insiders sell for a variety of reasons, but they only buy for one reason. These insiders believe that the price of the stock will increase in the future. We want to find open market purchases by multiple C-level executives or directors. If you think about it, this really makes sense. If these insiders are personally buying their own stock, this tells us that the insiders are confident about the future of their business. And who is better able to tell about the future and the health of the company than the insiders themselves? Ideally, we want to see open market insider buying when the insider buying takes place either during a long base building period or just after the initial breakout. Over here, we are combining both the fundamental criteria together with the technical criteria. So the fundamental criteria in this case is open market insider buying, and the technical criteria we want to take a look out for is the long base building period. Take note of all these fundamental buy criteria and technical buy criteria that I'm sharing with you. They should not exist in isolation. Rather, we want to combine these criteria together and then make our investing or trading decision from there. For the 8 fundamental criteria, Jesse Stine wants us to look for low float and market cap. The float of a stock is the number of shares available to trade in the open market, and he mentions that best performing stocks generally have floats under 10 million shares, and they also tend to start with market capitalization under $100 million. The 9th criteria is the it factor. So we want to look for a company that has new customers, a new partnership, a new invention, a new technique, or a new technology. Basically anything that is new and has a wow factor. The next one is conservative management. Super stock management teams never predict big things. They consistently underpromise and over-deliver and let their results speak for themselves. The 11 is low short interest. So super stocks almost always give low short interest at breakout, less than 20% of a stock's total shares outstanding. The next fundamental buy criteria is insider ownership. A management team that holds a large stake in its stock is preferable to a management team that does not have much skin in the game. So if the management team believes in the future of its own company, it makes sense that the management team holds a large stake in its own stock. So those are the technical and fundamental criteria on what to buy. But what to buy and the identification of super stocks is just the tip of the iceberg. We also have to take into account the optimal buy point and sell point and the psychological preparation that go into a major trade, because these are much more difficult to master. What I've just shared with you are the technical and fundamental criteria, and these criteria are a bit more quantifiable. The optimal buy point and sell point and the psychological preparation are less quantifiable, and that is why they are much more difficult to master. Now we'll take a look at some low risk entry points. For low risk entry points, we'll be taking a look at these 4 things. The first is moving averages, the second is buy light and tight, the third is buy the gap, and the fourth is wait 2 to 3 weeks after monster earnings. On the topic of moving averages, Jesse Stine mentions that this is the ultimate low risk entry point, especially when prices moves to one of these lines. And for Jesse Stine, his preference is to take a look at the weekly time frame. The second is buy light and tight. Jesse Stine mentions that at the tail end of a multi-week base building period, so that is the base that the stock forms, a super stock will tend to move within a very tight band on relatively light weekly volume compared to prior weeks. This is similar to the VCP pattern that Mark Minivini uses in his trading, and you can check out that video over here. Ideally, we want to see volume decline to roughly 30 to 50% of the peak volume seen during its biggest advancing weeks. And since volume moves price, when volume returns, it is usually off to the races for the stock. During the basing period, we want to see the volume for the stock to be lowering, and when the stock breaks out of the base, we want to see volume pick up. After a substantial earnings surprise, most super stocks will gap up and trade well above the previous day's close. If the stock gaps from $10 to $14 and steadily trades higher throughout the session and closes at $16, the gap is between the $10 range and the $14 range. And in an ideal scenario, after a surge over several days, we then want to see the stock trading back down to its gap support around $14. And according to Jesse Stine, that is where we want to enter our buy position in the stock. The fourth one is to wait 2 to 3 weeks after monster earnings. Jesse Stine mentions that many biggest winners tend to provide excellent low risk entries 2 to 3 weeks after their breakout earnings announcement. So if we did not manage to catch the monster earnings, Jesse Stine believes that we can wait 2 to 3 weeks for another low risk entry into the stock, because he mentions that as enthusiasm wanes, super stocks tend to settle down for a couple of weeks while volume steadily declines, and this provides us a good low risk entry point. The third lesson that Jesse Stine shared in his book, Insider Buy Superstocks, is about averaging down. He mentions that since the stock has already passed our strict criteria and has made our shortlist, unless the fundamentals of the stock has changed, don't think twice about buying at a low price. And if you own growth stocks right now, this might be a good time to average down on our positions. Because if you believe in the fundamentals of the company, if the fundamentals for these companies hasn't changed, then we should continue buying it at a low price. Jesse Stine also mentions that once you have several stocks on your radar, simply buy the ones whose price fall down to a low risk support levels. The fourth lesson that he shared with us in his book, Insider Buy Superstocks, is stack the odds in our favor. And by this, he means the risk to reward ratio. The risk is defined as the potential downside, and the reward is defined as the potential upside. So in investing and trading, we need to have a favorable risk to reward ratio. What this means is that our potential upside or our reward is greater than our potential downside or the risk. Jesse Stine mentions that for the downside, we always want to determine in advance what we are willing to risk. For example, if you are thinking about buying a stock, you have to determine in advance what you are willing to risk. Whether it's a fixed dollar amount or fixed percentage, you need to determine in advance what you are willing to risk. And once this level is determined, you must have a predetermined mental or physical stop loss in place. For this part, I prefer to have a physical stop loss because having a physical stop loss takes out the emotion that I might have when I'm investing or trading in the stock market. And for the fifth lesson, Jesse Stine mentions that we should not listen to the news. When we are watching the news, pay attention to the facts and breeze past the opinions. An example of facts on the news is GDP or the economy grow by 5% in the last year. And an example of an opinion is that economists and market participants believe that the economy will continue to grow in the future. So Jesse Stine mentions that we should pay attention to facts and breeze past the opinions, because the news is always wrong at critical market turning points. And this is a very important point to take note. Take notice when major headlines from several distinct media sources all sing a similar tune. For example, if all the major headlines are talking about a crash, this might actually be a very good time for you to take a look at buying stocks, because at the very precise moment the media is cheering or crying the very loudest, it is often the case that the charts are signaling a very powerful move in the exact opposite direction. So if the majority of the media is cheering, it's often the case that the charts are likely to decline from there on. If the majority of the media is crying the loudest, usually the chart will signal to us that it might be a good time to buy our stocks. These are the 20% in Jesse Stine's book, Insider Buy Superstocks, that I believe can make the most difference in your investing and trading. If you have learned something from this video, smash that like button because it will really help the channel grow and allow me to produce more content such as this. And if you are new to this channel and haven't already subscribed, make sure you subscribe to this channel because each week I release new videos about the stock market. So on Thursday and on the weekends. I'll see you in those other videos to your financial success.